Hey everyone, and welcome to the Bricks, Bucks, and Bytes podcast, your weekly dive into funding, market, and investor news in architecture, engineering, construction, and supply chain. Before we get started though, if you're a startup founder or operator responsible for innovation in your company, or you want a deeper, more insightful look into technology in AEC, you won't want to miss our newsletter. From deep dives into particular technologies such as AI, robotics, design, software, and so on. Hot takes from investors betting big in AEC technology and advice on building tech companies, including the stories and takeaways of the most successful AEC technology founders. Head over to www.bricks-bytes.com and sign up today to get this exclusive material straight to your inbox. And now for the episode. Good morning, guys. Patrick, it's nice to have you back back into your usual environment.
Same here. I'm, very autistic that way. If I'm outside of my environment, I do not feel safe.
You've done a very good job, though. We were very impressed, and we were very flattered by the commitment to the Bricks, Bucks, and Bytes podcast.
Well, it was easy. We had Moritz on. He did the whole show, right? That was pretty insightful, I thought.
Yeah, you were asking good questions.
Yeah, one or two.
Martin, what's been going on this week?
What's been going on this week? We've been working on a release of Monumental Super Series. So that's something big coming very, very soon. Other than that, we're getting into winter. Nothing exciting on my
end. Just to maybe let everyone know that I turned my radiator on just like 10 minutes ago. So if I just fall to sleep suddenly, it means I need to probably go and get my gas sorted out or similar.
Hey, I want to share an anecdote actually before we jump into the topics. So the three of us, when we're on here, every now and then we sprinkle in a detail from our private lives. And this week I had a founder who actually used one of those details in a pitch to me. He said, "Hey Patrick, I heard how your wife is preparing meals and that you don't agree with her on that she's not really taking down the recipes as she goes in order to make them repeatable." To be honest, that's been the founder said that's been my success with customers. Is that every customer I basically give a preferential treatment and a separate treatment, and it's how I cook as well. So your wife is onto something. I thought that was pretty cool.
Yeah.
As you're speaking about him, it definitely worked. Yeah.
I liked the founder a lot before that, so I think he might have felt like there was already the room to make that comment. But
and also you are quite generous on Fundamental website about how you guys describe like yourself. There's like a whole interview there, right?
Yeah, indeed. And by the way, that is not AI generated. All of that is written by ourselves, our letter to, etc. So no BS there. And as you spoke now about winter, here's another detail. I actually like autumn and winter more than I do summer.
I love autumn. I think there's that time of year you can put a jumper on and the walks. It's so much fresher, the air, right? It just feels nice.
Also, maybe this is a northern hemisphere thing. I have to experience autumn in the southern hemisphere as well. But I feel like in the northern hemisphere in autumn, you have this time frame, October to early November in like where I live, where the light from the sun, it is different. It is warmer. It is nicer. It is crisper. Of course, when it's not raining.
How about romantic?
I'm stepping away, guys.
Hey guys, look, talking of personal lives and winter, look, let me show you something from my heritage. I've got it on the back of my chair. Not to hijack the conversation. Have you seen one of these before?
Are you selling them or what?
Is this merchandise?
Bricks and Bytes merchandise, yeah, completely plain. But this is like it's called Aran, so it's like a type of material, wool, which comes from Ireland, which is where my ancestry is from, and it is super, super, super warm. So if you need a good, nice, cozy winter jumper, hit me up, guys. I will embroider one for you.
Is it one of these materials that also, if you wear it and it's warmer outside, you will not sweat?
I actually I could not confirm, and I'm not sure I even want to test that.
Is it Arism, like Uniqlo?
Don't insult my heritage.
To wrap up the weather comments, I think autumn is nice, but we're definitely not going on holidays together. And there's nothing like a Spanish beach walk in summer.
Fair enough.
Okay. Hopefully, the listeners enjoyed that little segment. Shall we move on to the juice? So, in today, we're discussing a Norwegian startup called Findable. We will then be moving on to Holcim have invested in a low carbon technology for cement, but we will be using that opportunity to discuss the whole notion of low carbon materials, sustainable materials, etc. And then we will move on to a little investor's take about amount of revenue versus whether M&A or IPO are possible. I'm not sure about my English.
And by the way, as we go there, sorry, if you go back to Trace, when we get there, you can see on the right, he also made predictions about venture capital in 2018. So let's also double check how those came to be. And he said SoftBank disrupts venture capital. I would say that is a take he might want back.
I've heard that it didn't go well.
Okay, Martin, do you want to kick us off with Norway?
Let's do my reading skills.
Talking of cold places.
A Norwegian startup transforming building documentation has raised 9 million euros in a Series 8 funding round led by Point9, with participation from Compass, Construct Venture, Molling and Co-Venture, and Lake 8. Findable's AI-driven platform organizes scattered building information, enabling faster compliance with safety regulations and improved sustainability. This funding will fuel product development, team expansion, and strategic entry into the UK market, where stringent safety laws create high demand for their innovative solution.
Say that again.
Was that?
I said you can say that again. Stringent safety laws.
Not
Literally.
No. So, Patrick, have you spoken to Findable? And what's your take on their product and their position in the market?
Yeah, we spoke multiple times over the years. I want to say the last 2, maybe 3 years with Frederick and his team, and been constantly quite intrigued, if not impressed, but definitely intrigued with what they have been building. And so from a customer perspective, say you're an owner of a real estate portfolio, what you can do with Findable is basically dump all your documents that typically you would have. If you're in real estate, you will know this. You will typically have binders and binders and folders of hard copies of all the whatever maintenance documents, handover documents, invoices, all of that. Talk not even BIM and whatever. Somewhere standing around in your office. And then if you need to find one piece of information, it's extremely cumbersome. It makes decisions slow, etc. And so that's where Findable years ago, I want to say maybe they started 2019, if my memory serves, started developing their own AI model. I think they didn't call it at the time that, but nowadays that's a better word to describe it. Trained it on a lot of documents and handed over a piece of software some time ago to these customers in order to query all their documents in a very simple and intuitive way. Now, had they started in 2022, perhaps they would have built on GPT and wrapped GPT around it, but that's not what they did because they started earlier. They had actually built some form of own technology and model in order to allow customers pre-2022 to start querying their documents. And I think it is this own proprietary and trained model that intrigued Point9. Christoph here would be my guess. They also had what I thought was good execution. Definitely something where it's not just a technology and a narrative, but it's also a company that actually has real business and real customer adoption with what we found to be real customer love. We liked the company a lot. For us, the round was too large to make sense.
It's for me when I see these like for AI documentation management and construction, right? It's like there's a lot of startups tackling. Well, this is more real estate maybe, but we're in a similar arena. There's a lot of companies doing this. So maybe my next question was going to be, are they the market leader in this space? But I think based on the ones we've spoken to, which strictly deal with construction documentation management, maybe they're not competing. I'm not sure.
Yeah, like what's the differentiation between those solutions, and who is the customer actually?
So in this case, and I think you can see it from the press release, so I'm not spilling any beans here. You can see that here it's about building management. You can also see it in Frederick's quote. So it's not currently for the construction phase. Of course, when you hear the ambitions of any founder in this space, they might tell you that, hey, what if we do it for after the construction documents have been completed and handed over? Why shouldn't we be able to also do it while the construction documents are sort of in production during the construction phase? I'm not so sure. It's that easy. It's a completely different process. It's a completely different customer profile. Here, since it's for the building management phase, it's the people who are managing the buildings. Mostly that will be portfolio owners or the asset managers. For that will today be the customer of Findable. Whether that is differentiated, I honestly have my trouble seeing that. However, in that space, Findable is the one that I like the most. Congratulations to our friends at Compass. They led the seed round prior to 0.9. I thought that was a great find. No pun intended. But for me, I would find it very difficult 2 years ago and in 2024 as well to identify the features that will tell me this early, hey, this company is the one that will win with, let's go ambitious here, 200 million ARR, and they will persist. Also, final point, you have to consider one thing: selling into real estate asset owners and asset managers is a very, very tedious task. The distribution is not simple. The metrics that we saw in Findable look to be very capital efficient, but they were so also in specific countries, while new countries might, based on past experience, need a different motion, and perhaps that has a different economics. So selling into real estate is something that I would imagine now they're using the Series A money in order to hone that motion. And if they succeed, then that might be the differentiation.
Because I would have thought that a lot of these large real estate companies probably have some kind of like AI enterprise tool that they're developing or having developed for them, which could perhaps do what Findable do for their potential customers. So I wonder who their target market, whether it is those like large, in London, one I can think of would be like CBRE. I actually think they're a global company.
Real estate. Because these people own hundreds of thousands of square feet in London, for example.
Yeah, I mean, that's certainly the customer group. And then you have in the real estate space, you have millions and millions of asset owners, hundreds of thousands of asset managers. Portfolios are not always as large as the ones that you have just mentioned, but there's many, many in a fragmented space, which is why I'm saying the eventual defensibility might actually not be in the technology or the product. 0.9 tends to be a product investor. I'm not convinced this is in the end going to be won by product. I'm convinced this is going to be won by distribution.
Yeah, and what is actually good in case they would be able to get into these customers. These people have like millions of square feet of commercial real estate or residential perhaps as well. Then the distribution across the company would be fairly easy, but just need to get in there first. Yeah. You mentioned too large round. That's a probably dumb question, but maybe there is something, at least for me, in this question. Does it mean that the valuation is too big if the round is too large?
Hey listeners, I want to take a quick break to remind you about the Bricks and Bytes newsletter. If you're interested in learning about the technology shaping the future of construction, you won't want to miss the valuable insights we share each week. To get this exclusive content delivered straight to your inbox, head over to www.bricks-bytes.com and sign up today. Link is in the show notes. Back to the show.
So there's only three variables in this equation. It is the valuation, the round size, and then the eventual dilution. So when you know one of these already, here it was a 9 million round, then you only have to ask yourself, hey, what do I assume either the valuation to be or the dilution? And typically the dilution is almost always in plus minus a few percentage points, the exact same range. So that gives you the valuation. In this case, I do not know the valuation, but my guess would be it's probably 35 pre, maybe. would be my guess, somewhere in that ballpark. And personally, I think that is being paid in the market. So if you approach it from just where the market stands right now, especially in Europe, which has been expensive ever since there was no relief in Europe, you can justify it. From if you approach it more a fundamental value perspective, I would not have paid that valuation.
Okay, that's fair. Okay.
Patrick, if you're I would maybe think about people building AI startups in today. We discussed this previously, and you mentioned it already about one of the key things people should be looking at is distribution within these things. Are there any other areas of defensibility that you perhaps look at from an investor's perspective if considering an investment in an AI platform?
I was writing an email this morning to a founder who asked for our feedback after he gave us a pitch, and it's a vertical AI and AECS. And I truthfully responded to him saying, in many spaces, themes, technologies in AECS, we know our framework where our conviction is to pick. Robotics, I know what I look for. I know what I pass on. Workforce issues, same thing. The design stack, same thing, and so on and so forth. And I use the metaphor on, I know which horse track I want to play on. Now I'm just basically picking the horse that I think will win the race extremely early, day zero, right? That's what we do. In AI and AECS, I cannot claim that we have found that. And I also am not convinced that any other investor can claim that they have found that. I actually think, to stay in the metaphor, people still have to figure out whether they are even on the right horse track with regard to AI. And I told that founder, look, sometimes you will get these mega funds, 3 billion funds, and they will give you the impression that they have high conviction, but actually what they are doing is an indexing strategy. They are backing every horse track out there with regard to AI and AECS up until Series B. And then when companies are obvious by the numbers, they will orphan you and back the other horse on the other horse track. And then you're left hanging, right? Because we don't manage 3 billion, indexing is not an option. I also don't think that should be the job of the investor, because it drives relatively poor returns for my investors if I were to do that. But I also can't play that strategy, which means that I need to find my own convictions framework so that at day zero, I know which horse track I want to play on. And in AI and AECS, for many of the plays out there, I cannot claim that. I'm still honestly spending time figuring that out.
Can we just clarify what we mean by AI in AECS? Because like the way I see it, which might be wrong, is that AI is technology in itself, and you're using this technology to tackle a particular problem in architecture, engineering, construction, perhaps, right? So it's like solving a problem using other technology, which is AI, right? So are we talking about the same things, or are we talking about some technology which is like AI is a base layer applied in the construction space? Am I saying it?
So that's a very, very good and observant point. So let me give you 2 examples to demonstrate exactly what you're pointing out, Martin. So AI in autonomous machines for construction sites, that's not a new thing. We don't use LLMs in there. It's a different form of machine learning that has been applied there for years. Safe AI, for example, is someone that plays in that space. And so that is very, very differentiated and very difficult to copy. Now, when we say AI right now, most people will mean large language models or large multimodal models in order to manipulate semantics, query semantics, and basically that way be able to do certain automations that we weren't able prior to querying semantically efficiently. And that in itself is perhaps not as defensible. So you will have to find a way how that is perhaps not the core of what you're doing, but you have something else that you build around that becomes very difficult to copy. And that is something that in most companies that use semantic AI and AECS is very hard to see currently.
Yeah, it feels like every day or every week, out of the blue, one of these big incumbent AI software just announces something, and you're like, oh, there's another 1,000 AI startups that no longer have a product.
exactly. I spoke to a founder the other day who's also building something in the hey, let's use LLMs to query document space in construction. And he was quite frank, right? So he started prior to LLMs becoming ubiquitous. So they have been underway for years. He said, look, I mean, LLMs basically, I'm under no illusion in 12 to 18 months, they will do exactly what we're doing right now, if not better. So I now need to find a distribution advantage. And the distribution advantage that I want to go for is I want to build partnerships with all the project management softwares, workflow softwares out there so that they distribute me. And perhaps I think that's what he's trying exclusively. So that could be a defensible advantage if they succeed. But I also wouldn't see why any of these platforms would commit to one technology that will be replaced in 12 to 18 months. So
or even earlier.
I wonder if there's a flaw in that thinking.
Yeah. Like there is OpenAI was valued, I think last week or 2 weeks ago at $150 billion. And I guess this type of people are like leading in LLM creation and innovation. And I don't think anyone can compete with this type of money and this type of company on the LLM generation kind of level. You can perhaps quite easily take this technology and apply it in construction to a degree, like do like a point solution wrapper, which is definitely not defensible in that case, because someone can do it slightly better or more efficient. Yeah. We don't know.
So interesting space, and maybe from a VC perspective, quite risky to start placing your chips.
So I do think what's smart about the Findable investment is, one, they had what I thought very good traction, not traction that I would have paid this valuation for, but very good traction. Clear customer love, very strong product metrics, stickiness metrics, cohort metrics. I've been very impressed. I think the team is awesome. I would have loved to work with the team. So I think there's many, many reasons why just as a company, it's absolutely worth backing. Much better than many of the companies in the AI space, in our space, you will ever get to see. So I think it's a bet that is very reasonable and could become a great bet. I also like that in general, the vertical application here will breed less competition. Now, the problem here is if you go after a super specific use case let me give you an example. I'm currently talking to a team that uses AI in order to find compliance mistakes during the design phase and the construction phase in 3D models. That's a space, unless you have worked in that space, you will not know what to look for and you will not attack it. So it's what we call hidden in spite of obvious. Going after real estate documents is not that. It doesn't matter how often you tell yourself, but it is very obvious for generic people what to do here. So you now need to build a distribution moat around it, in my opinion. But if anyone can do it, I think it's Findable.
I think that is, on this note, just to switch tone slightly. Patrick, we took the super series we've done with you guys and uploaded to Notebook LM.
Yeah.
And it created a podcast. And it came up, one of the first things it came up with, I don't know if you listened to one of these podcasts, they are freaking amazing. And one of the first things that came up was your framework. It was the fundamental framework, which I thought
hidden in spite of obvious.
Yeah. Where I thought was absolutely like, what? I don't know. I had no words. I was like,
that's
wow,
awesome.
how is like pick that out of, I don't know, 7 or 8 hours of content.
That is awesome.
Yeah.
It was, I think it was 7 to 8 hours exactly.
Yeah. Okay, shall we move on to another sort of topic, which I suppose has similar sentiment to AI, in that there are lots of solutions out there on the market trying to tackle, but the industry, but perhaps questionable. I think this is like a personal bias, by the way, but I just see a lot of these kind of headlines there where people have found the next low carbon cement or the next building material which is going to cure all sustainable material problems. So the headline of this is Holcim. And Holcim, as far as I'm aware, is a material supplier in construction. Is that right? Manufacturer. So Holcim,
it's mostly a cement company. Yeah.
Okay, cool. Holcim invests in Sublime Systems to scale up innovative low carbon technology. Man, what's your views on, as a structural engineer, low carbon cement? Is it possible?
I think that I'm not a material engineer, so I think that there's an issue with science that it's very difficult to overcome kind of the next step to make this concrete or cement fairly cheap, which is super relevant and important, fairly cheap and sustainable. That's how do you drive these two factors in the same direction, like cheap and sustainable? I think, and you probably can do it if you pour a lot of money into it, but I don't think anyone is willing to do that. So I think we probably just need time, and it's difficult to innovate within science. Yeah? Patrick, what do you think?
So I have 3 or 4 takes here, but they are not specific to Sublime. Let me unpack. So the first one is, I am not of the opinion. So actually, let me start with an observation. So the amount of capital that is available for scientific breakthroughs, be it in pharma or be it in material science, including building materials, is staggering. It is very, very large. Regardless of what anyone wants to make you believe, the amount of capital available in that space is, I would even say, ridiculously high. And it's being managed mostly by people with no science background, i.e. venture capital managers. I have no science background either, but I also don't manage capital to allocate into science companies, especially not exclusively. So that's a very important consideration. And these people have, when they manage this capital, certain incentives. The incentives are, hey, here's 10, 12, sometimes it's 15 years when it's a very long fund to invest, but then also divest the money, return the money, and close that fund again. So that puts a deadline against how long you can truly be involved and what kind of companies you can look for to return the capital. And part of that incentive structure within the timeline then is, hey, if I raise more money, I can have more what we call management fees. Because my management fees are typically a derivative of the amount of capital commitments that I have. And I can deliver profit. And as part of the profit, I get a profit share. That's the carried interest that we discussed a few weeks ago. And at some point, if my management fee, because my capital commitments are so high, and I personally don't think I'm in an asset class where I can deliver much profits, I have an incentive to just manage and not deliver profits. That's an incentive structure you need to understand. Now, if you now give all this capital to venture capital managers or PE managers, doesn't matter, that have no science background, how do you differentiate which companies are truly going to be difference-making versus those that are just vaporware? I claim it's impossible for these managers without a science background and with those incentives to truly differentiate that. And that's how they are going to allocate capital. They are going to allocate capital into the most charismatic founders. They're going to allocate capital into the stories that will attract more capital down the line. And so the product does not become the product that customers receive. The product becomes the value of the stock, which is a derivative. And we live in a derivative market, if you haven't been paying attention, for 15 years. And that's exactly what is happening generally in the building material space. Now, with regard to Sublime specifically, we've talked to Leah not much, most of it in 2020 and 2021, been very impressed with her. But also we've been unable to judge whether this is the breakthrough that you should back. And we've realized through speaking with Sublime and speaking with probably 200, 300 other companies within the building materials, especially also low carbon cement space, that our conviction is you cannot shortcut scientific, either physical or chemical breakthroughs with more capital. Moonshots in this space, other than digital, do not get shortcut with more capital. And the reason is the fundamental research behind it does not follow time plans. It follows, to a degree, serendipity. And this serendipity cannot be accelerated with more and more capital. So now, when you realize that, you can either back established scientific principles to industrialize them. That I believe very much in. And for that, unfortunately, there's not enough capital out there. Or you can allocate capital because you believe, wrongly so in my opinion, that you can shortcut science because you're backing low technological readiness, fundamental research type companies. That, I think, is what's going on too much in this market. I personally, and that's my point here, am unable, with regard to Sublime and many others, to differentiate the breakthrough from the vaporware. And that unfortunately means that I cannot play in this market particularly effectively. And that's a realization about myself. And I wish that founders like Lea will have the ability in the future to work with companies and investors that have that scientific background. Perhaps that's the case here with Holcim, and I think CRH invested as well. I wish that to be the case, but I don't know that to be true.
It's kind of tough for people innovating in this space, seems like, as this is really like substantial thing, like to innovate within the space. If you really can make a breakthrough, then the like a tangible impact you might have is absolutely gigantic, right? But difficult to invest because, like you said, there's no VC. There's no VC scientists out there.
And unfortunately, because they're so I think the point that I'm trying to drive home, the problem lies with the LPs, with the capital allocators. They give their capital to the wrong general partners. That is the problem. And because they give the capital to the wrong general partners, they should basically, what they should do is they should concentrate tens of billions or hundreds of billions in a few number of GPs that have a scientific background. And then they should incentivize them only on profit and only with a relatively long time horizon to truly incentivize them to differentiate the vaporware from the breakthroughs. Now, if you set it up that way, that would mean that founders like Lea, who truly are working on potentially something breakthrough and get recognized by the scientific community allocating that capital as a breakthrough, every capital would get concentrated in these companies. Now, unfortunately, we do not live in this world because unfortunately, we have a ton of business MBAs who try to allocate capital into science who completely spoil the asset class. Because now what I'm seeing is 50 different press releases every year where 50 million get allocated in a building materials company. And just statistically, I know that 49, 48, 47, something like that are vaporware. So now I, as someone that doesn't have that background anymore, how do I differentiate? It becomes even harder. It becomes even murkier.
Yeah, marketing narrative of innovation does not equal innovation, like on the base layer of this innovation.
Exactly. So leave the science investments to the scientists. That's my call to action here.
I think people also need to consider the people that will be installing this cement, or is the right word installing? Pouring, maybe. Will they actually use a material like this? Because especially in the UK, the implications of getting it wrong are so ginormous that everyone is super scared. And right now, I was speaking to an architect yesterday, and I was discussing this with Martin earlier. And Martin, you can give your take if you want after. But they are architects now because the people that the building control officers, the people that usually sign off whether a building is compliant with the local regulations, the resource, there's just not enough resource there to be able to sign the buildings off. So what they now do is they make the professional team, like the architects designing the buildings, sign off personally that what they have designed is compliant, which is a new thing. And so, in my opinion, why would you take a risk on specifying something which has the potential, which is new and unproven and may go wrong, perhaps to get a call in like 20, 30 years time when you're retired, sitting on a beach saying, oh, remember that low carbon cement you installed 20 years ago? Yeah. We're having some major structural issues.
So if you want to, I can only lose friends when I give opinion on this subject. I'm happy to do so. So I actually think that's a very good thing, because what it breeds is responsibility. So you can't. So what you will get is people will be more a decision maker rather than to be pushing things to someone else, who will then push things to someone else to make a decision, which is usually extending decision-making process. And that's why you have so much red tape as well. So I come from Eastern Europe, and when I first went to the construction site in the UK, I was shocked by the fact that anyone can be a site manager, because in Europe, I don't know about Germany, but in Eastern Europe, to be a site manager, you need to have a bachelor's or a master's degree in civil or structural engineering to do that. So I think it's only going to be better, because people will feel more pressure to make good decisions rather than bad decisions. But yeah,
that's a good point. And I think the low carbon cement space, everything that my network tells me, network of scientists in the building material space, which I am not, oftentimes you hear the same answers. You hear the answer of, yep, that approach works on a lab scale. And I will very, very often hear the same thing, rightly or not. It's just what I'm hearing. And because I'm not a scientist, I need to rely there to a degree. But it's not industrializable. I don't think you can scale this process. I think it's too energy intensive, comes often. I think it's very costly for other reasons. But on a lab scale, it works. So truly what I believe is you can probably, when you demonstrate that the material is durable, as having the same properties as conventional OPC, ordinary Portland cement, you can probably make a sell. But today you probably have to charge higher for the product. So you will have to sell into enthusiast projects, right? You could, for example, Microsoft. If Microsoft were to build a new headquarters and they were to choose concrete, I'm quite certain they would consider paying up for the concrete that contains low carbon cement, because Microsoft could afford it. It could be part of the narrative because Microsoft has a very strong carbon footprint, as evidenced by the annual reports, etc. But that will be a small portion of the market where you can sell into enthusiasts. But at least that gets the ball going. But you still will have to prove how outside of that enthusiast market you can actually become the mainstream. And so that's an industrialization problem. I would absolutely invest in the industrialization problem when I don't have to, when I can be certain that it's not vaporware, but that it is truly the breakthrough, and then make the industrialization bet. And that's where the capital, unfortunately, is not concentrated today. And that's where I wish that our asset class is concentrating capital in much fewer science GPs and then betting on the industrialization. That's what we need.
Very good take.
I will go back to the question I asked a few weeks ago. Is this a situation, and perhaps this is just the definition of the VC world, maybe, throw enough darts at the board and eventually you'll get the bullseye.
Yeah, or throw enough darts at the board because your incentive is you earn money by throwing, not by hitting.
Sounds like a great career choice. Okay, shall we go to Trace's thoughts and also 12 predictions for venture capital, which I haven't even looked at. So I mean, I'm like really tempted to click that tab, but we'll wait. Okay, so this is Trace Cohen's post, and Trace, for the benefit of our listeners and people perhaps not watching, is involved with family offices, venture capital, memes, and has 2,000 newsletter subscribers. Damn, more than us. Okay, so his take is caught up with lots of investors this month, and there are so many startups from 6 to 8 years ago that are doing 50 to 200 million in revenue, growing slowly, close to cash flow positive-ish, but too highly valued for M&A, even if an option, and don't have potential for an IPO. What will happen?
Can you translate it, Patrick? What does it mean?
So Trace is referring back to the times from 2018 to probably end of 2021, where in the zero interest rate policy environment, we had very non-discriminatory spending of VC for people who are not perhaps every day in the industry. That there were days where companies would start the fundraising in the morning and have 10 term sheets in the evening. This literally happened in 2021. There were years, especially 2021, where funds raised 750 million in January and had spent 750 million by December in the exact same year.
Goodness.
That is problematic on many, many different levels. And again, to something that we said earlier today, The product at that point was not the product of the company anymore. What the customer bought, the product was the stock in the company and what you thought someone else would pay for the stock tomorrow. To a degree, by the way, we see the exact same thing in 2023 and 2024 in AI. It's repeating. So Trace is taking us back here and say, hey, this happened between 2018 and 2021. So these companies raised a ton of money with very little traction, were completely inflated. Take the example, perhaps, you had back then 0 revenue and you were valued at 500 million. In 2021, you had raised $100 million. You might still have money today because you cut back on spending and your management discipline improved in 22, 3, 4, but you're still technically valued by the investors at the last round at 500 million. Perhaps now you have 10 million of revenue. Who's going to pay 500 million for you? Nobody, because your growth rate probably decreased because you decreased the spending. And yet you're only at 10 million. So that would be, and let's say it's ARR, let's say you have great customer retention, that would still be a 50x multiple on where you are. It's not going to get paid in the current market for a lot of companies. So he's saying, hey, if you're now still burning cash, if you're a leaky bucket, at some point you will have to either raise again or you will have to exit. But who's going to pay what your last investor paid? That's what he's pointing.
Yes, this is like, to me, a little bit ridiculous. Like, how can you you're not being profitable, right? And raising hundreds of millions.
Not even generating revenue.
Not generating revenue and being valued at so much. I'm just actually very surprised.
You're describing almost every AI company in 2024. Yeah, almost every, not every. There are AI companies that do terrific revenue, but almost every.
Yeah, I'm just very surprised that people don't predict these things. In if things are bubbly, then people don't see that it's not gonna work because you guys are professionals, I guess, because of X, Y, Z, whatever that is.
Well, look, I think there's been a lot of GPs that were swept. So this is a side problem of those types. There were a lot of GPs and investors being swept into VC because VC as an asset class bubbled. There was more capital available, more people were hired, and these people actually had never seen a recession. They had never seen an IPO. They had never seen the ups and downs of a business. And so now you're telling them, hey, I have 750 million around. We need to spend them this year. Go find companies. You become a salesperson, not an investor. And so there were a lot of them during those years. And that then means that you lack perhaps competence, perhaps worldview, perhaps incentives to actually differentiate substance that would outcompete in the long run from, hey, I can think of someone that buys my stock tomorrow.
Mm-hmm. So what's the end game or next step for these companies? So that's one thing. And another thing, do investors invest in like a down rounds? I think that's the name of this.
Good question.
Yeah. So down rounds happened a lot in 2022 and 2023 for companies that were dire for cash.
Sorry, question. Does it happen in AEC or not necessarily?
Also happened in AEC. I have seen it far, far less as a percentage of companies in AEC that we have seen in buddies of mine and many, many other industries, but it also happened. Yeah, of course. Because there were overvalued companies in AEC too, but because we invested from a far lower baseline, the amount of craziness was lower. It was dampened, which is why the concentration was a bit low. The concentration of like down rounds was lower. But yeah, there were examples, absolutely. So you have to differentiate as a founder. If you're leaking cash, you're going to run out of options. You're not going to be default alive that way. And then probably the way to do it, if you're in the situation that Trace is describing here, 50 to 200 million in revenue, and you're still leaking cash, I would make the prediction that nobody is going to touch you except for a very low ball acquisition offer. Mm-hmm. If you're at 50 to 200 million on the other hand, and you're close to cash flow break even, and by close to, I mean like really, really close to, not, I only burn 10 million a year. That's not close. You're really close to it. Then you should find M&A offers. IPO is not going to be an option at that scale. In most markets, Some markets have a very liquid mid-cap IPO. But in general, it's not going to be a very exciting path or exciting story. But you should find M&A offers if you're in a software type business, because there are good software aggregating companies in M&A out there. If you're a marketplace that has because he's only referencing revenue here, you could also apply to marketplace, and a marketplace that has 50 to 200 million in GMV, which is the gross revenue technically in a marketplace that is the supplier on record. That's not particularly exciting scale. So that will not give you a very meaningful outcome either.
Okay.
Shall we go to 12 predictions for venture capital? I also saw this funny one. Founder friendly is not dead. I'm trying to interpret that. I don't think
friendly is not dead.
I don't think I spoke to a VC who claims they're not founder friendly. Yet.
Some things that will be in every pitch everywhere.
Let's see how this one aged. So he made 12 predictions in 2018.
Okay. That sounds like a material for the whole episode, but let's try it.
Then we can just quickly maybe just shoot through them. The bigger seeds rounds will continue.
Yeah, probably happened. Yeah.
Tick. More liquidity through IPOs and M&A.
I would say in 2021, yes. I can't remember whether 2018 was really that liquid. I'm not so sure.
VAR will need more time.
Yeah, he was definitely right about that.
Esports will level up.
No clue.
I think I would not know from a financial perspective, but definitely a lot more hype that I see. Blockchain ICO? What's ICO? Anyone know?
Initial coin offering.
Will finally deliver a product and be disappointing.
No, Martin, was there a product?
I don't think there was a product.
Well,
so it was disappointing anyway.
You have a reputation.
But
now.
Guys, brace yourselves. Brace yourself. The time is
next year.
No. Soon.
Increased frontier tech investments in all the jargon words. Wow.
Frontier is in like a frontier markets or
no? Frontier tech was a it's not used as much anymore, but it was basically meaning at the time what we would call today deep tech. So all the hard technology, hardware related technology, etc. I think he was wrong about the timing, but I think he was right about the direction. I think it's actually only now getting truly unclogged. Autonomous cars happened earlier, but I think 23 and 24 truly broke out in those areas.
Yeah, I think this is quite interesting because once you saturate the software space with kind of AI in the next few years, there must be at some point the outburst of like tangible tech being developed out of this software base. That's the feeling I have got.
I mean, in our opinion, at least, software is the key differentiator in hardware, which is, for example, why we don't look when I back robotics companies. I do not look for automation founders that build large automation in for example, the automotive industry. I do not like those founders to build robotics companies as much as I like people with a background in complex software and product for software to actually go into robotics, because the hardware part of it is slightly easier to assemble and put together.
Right?
Exactly. And in fact, if you come at it to take the argument even further, if you come at it from an automation angle, oftentimes you will look for automating everything, which is not the way how to build efficiently. And especially not in construction, which is a very complex environment. Whereas if you come at it from a product background, in software, you will look for components and you will look to automate only the next thing that is delivering ROI. So I have found these founders with that background to actually be more interesting for me.
Yeah, and we speak about that a lot in the super series that Martin mentioned with Monumental as well, because Salah background and even Seb software background too, and now building robotics.
Both of them.
And it's a key component to their whole operation and operating the hardware. So very interesting. Breaking media will be in for another tough year, 2018.
No idea.
I think it's interesting based on some chats that I've had with founders looking for PR for their funding announcements. There are like certain large tech publications that to them feel like just a tick in the box exercise nowadays, not somewhere that they necessarily want to be on. And to quote some, in air quotes, legacy media is dead. I don't know.
Guys, I just think he meant Bricks and Bytes saying media, so he was not right.
Now, time for some crazy and fun predictions. Okay, there's a few more here. Apple and Microsoft will get into a bidding war for Magic Leap. I don't think that'll happen.
Majorly wrong.
SoftBank will just give them another few billion because they will need it. Not sure about that. Politics will try to regulate the big tech companies with no effect.
Well, I think new iPhone has different, like uniform charger, so I think there was some effect on that.
True.
No, I mean, the opposite happened under Trump. So
you've got I think it's like 1 month to election day in the US, right? Today.
That's right.
There will be a tech backlash verbally, but we're too addicted to social media and it will only get worse before it gets better.
I have not experienced a tech backlash. Have you?
Nope.
What does it mean?
I guess what he means is like, oh, I need to have like digital detox and spend 3 months without tech. I had not experienced that.
Mm-hmm. Amazon will announce something autonomous cars. Nope. As far as I'm aware, they haven't.
Yeah, no data. I think.
Nope. Yeah. So I would say half of it aged well, half of it.
I think making predictions is not the best thing to do.
Yeah, look, if we have, I suppose let's commend his bravery for putting this into print on a post in 2018 and then all getting talked about in 2024. Okay, guys.
It's good when you are correct. It's kind of, it doesn't look good when you're not.
All right, guys. Thank you. And we will see you next week.
Thank you
very much.
Cheers.